This is Bloomberg Markets, and I'm Shonali Basak. And today on Bloomberg Markets, we're talking about Nvidia earnings, the market holding its breath with so much value concentrated in just one stock. But first, let's get a check on these markets overall, because, of course, we are just off of session lows, still lower on the day. We're at the S&P 500 at 56.22, about 0.2% lower. Bigger drops in the tech-heavy NASDAQ 100, now almost 1% lower on the day, about 0.9% lower. The two-year yield now standing steady, reversing earlier gains you've seen in the bond market, now at 391 on the 2-year, and the 10-year at 381, only about 1 basis point lower. Some midday movers here on the equity side. First, we're looking at Southwest Airlines, because Elliott Investment Management increased its stake and is advancing for overhaul. It is pushing for one at least. The stake now quickly approaching that 10% mark needed for bigger changes. The stake is now at 9.7%, and Southwest is dipping marginally on the day. We're looking also at Boeing, because the stock has seen some movement in both directions today. This after NASA announcing over the weekend that astronauts would not return to Earth on the troubled Starliner in orbit. Boeing now down almost 1%. And Apple has sent out invitations for its big September event, which will take place on September 9th. The company will unveil the latest iPhones, watches, and AirPods, including updates on artificial intelligence products in that Apple ecosystem. Now, Apple down still about 0.4%, along with broader technology. Now, markets are still digesting Jerome Powell's remarks Friday in Jackson Hole. The Fed chair said that more data would influence the Fed's thinking as it weighs rate cuts in September and beyond. But that's not the whole story. And Bloomberg's Michael McKee is interviewing Federal Reserve of San Francisco President Mary Daly to see what else might be factoring into the central bank's decision. He joins us now. And Mike, when you speak with Mary Daly, what are some of the more critical aspects of what you're looking for, given what we now know?
Well, basically, Shonali, the markets have jumped ahead of the Fed here and now are pricing in about 100 basis points of cuts by the end of the year. So is that realistic? That's a key question for voters on the Open Market Committee, of which Mary Daly is one. Also, how fast do they want to get down to whatever they think neutral is? Do they cut by 50? Do they cut by 25? Do they skip meetings? So now it's not a question of whether they cut. It's a question of what the sequence is and how they carry it out.
When you think, Mike, about the concerns that different members of the Fed have had regarding the job market in particular, it's really the next payrolls report that investors are really looking out for to get confirmation of whether things are weakening more than meets the eye. Do you think she's as concerned?
Well, she has been concerned and has shown a growing concern about the idea that the labor market could be weakening, but not weak. At this point, Fed officials tend to think that the labor market is pretty much in balance. And when you look at the underlying data that we get, there's about an even chance that the economy is too weak or too strong at this point. Jobless claims still very low, but some of the labor force flows showing more people becoming unemployed. The Fed doesn't know, so it's time to cut and maybe put a floor underneath it. The question nobody will be able to answer, though, until it is too late, perhaps, is whether or not they started too late.
You know, I think about the Odd Lots episode that was taped with Richmond Fed President Tom Barkin, and this idea that he's still worried about inflation, about where it could go from here, not at this current moment perhaps, but down the road. And Mike, I think it's been frustrating for a lot of investors that you have an election around the corner, you don't really know what fiscal policy is going to look like, yet you're making decisions about the direction of interest rates here that could significantly be looking at a different scenario heading into 2025. How much is inflation still on the minds of different members of the Fed?
Well, it's always on the minds of everyone at the Fed, but some are more worried than others. You look at somebody like Pat Harker from Philadelphia. Mary Daly has expressed some concerns. Jay Powell did not about the idea of inflation rising because labor markets are tight. So it's hard to say at this point exactly what's going to happen with inflation, but the Fed is betting it's going to keep going down. they can't really do anything about the political aspect of it, who's going to be in charge come January and what kind of policies are they going to adopt. So they can only at this point react to what they see. And at the moment, as Jay Powell said, they don't think that we're going to see wage pressures pushing inflation higher.
And Mike, really quickly here as well, we're not without economic data this week. It's not the biggest of data, but important data nonetheless, including consumer sentiment data later in the week, on top of tons of consumer earnings. At the end of the day, how is the consumer story really playing into how this economy is going to moving forward?
Well, we're going to get a report on spending at the end of the week, and that'll be important because we did see retail sales come in better than expected, but we want to see what happens with services and whether Americans are still spending at kind of the same rate. That would reassure the Fed. There's been a thought that maybe people would start to pull back. We'll see when we get the consumer confidence numbers tomorrow of whether Americans are thinking this is a good or a bad time to buy. Also, the Conference Board confidence numbers show what people think of the labor market. And that's going to be an important side note for members of the Open Market Committee because they're going to want to know whether people think it's getting too hard to find a job.
Mike, we thank you so very much. Of course, that is Michael McKee. And be sure to tune in to Bloomberg this afternoon with his interview with San Francisco Fed President Mary Daly, exclusively at 2 p.m. Eastern Time. And this week, Nvidia earnings are looming large. The company has had a historic run-up, but investors will be looking to see if the company is reporting continued revenue performance and positive outlook. You can see Nvidia's data center segment estimated to come in at $25 billion for the quarter. And we're going to be joined now by Mandeep Singh, who covers global technology for Bloomberg Intelligence. You look at that data center number, that's really the money number. What are you expecting relative to consensus and why?
I mean, there will be a beat relative to consensus, even though estimates have been revised upward. And look, they've done that for the past 6 quarters. And even going into this quarter, they will have a beat and raise. The question is by how much? Now, the good thing for them is we have received, a couple of data points from all the hyperscalers raising their CapEx, as well as TSMC expanding supply. And those are the things that matter if they want to sell more of their chips. The one negative was Blackwell getting delayed. Now, in the past, when they have moved from one architecture to another, Ampere to Hopper to now Blackwell, they always have seen price increases. So the one thing that Street needs to figure out is what kind of a price bump are they expecting from that Blackwell architecture?
Well, what are you expecting from that architecture, and how big of a stain is it that you have that kind of delay?
Well, so think about it. These chips are getting more complex. So every generation has got more transistors packed. The complexity is growing. So I'm not surprised there is some delay. And from a pricing perspective, yes, it should command a higher price. The question for the companies that are using these chips is, do they have to rely on the latest chips for their model training, or can they make software improvements? I mean, if you're an OpenAI or an Anthropic, do you just continue to rely on Nvidia to give the latest and greatest chip? Or can you make software improvements to drive that model improvement? And I think the answer is a little bit of both. Yes, the latest chips helped a lot in terms of speeding up trading, but I do expect down the line there will be software improvements, and that way I think that will put some pressure on Nvidia.
Speaking of pressure on Nvidia, you look at rivals trying to catch up in different businesses. You think about AMD's recent acquisition, for example. And at the end of the day, Nvidia has had a huge run up in the market. When you think about how these companies are putting money to work, whether it be M&A, whether it be CapEx spending, how are investors looking at valuation? Are they going to reward that CapEx spending? Is it kind of a CapEx war of sorts here? What do they need to do to stay ahead of that competition with the lead that they've already had?
Well, so in the case of Nvidia, it's about the product architecture and maintaining that lead. I mean, they already compressed the 2-year cycle time to 1 year, and they've been really undershipping demand. That's what we have been seeing in the data. But from a hyperscaler perspective, yes, they're increasing their CapEx. They have to show it in their cloud revenue, in their Copilot revenue. And for everyone else who is investing in these chips, they want the ROI. There have been question marks around when the ROI will come. But the use cases are becoming stronger and bigger by the day. So I think it's just a matter of maintaining that cadence where you continue to show a recurring revenue stream like the hyperscalers have done. But from a chip perspective, I mean, the only thing they need is their next chip to be bigger and better and to command a higher price than they were commanding before.
It's interesting, the implied moves, and you can find this by going to Nvidia's ticker on the terminal EESRP. The price move implied is 9.4%, give or take, in either direction after this report. So about 9% typically, nothing out of the ordinary here, really. What do you expect in terms of investor sensitivity here? At the same time, we've been talking about valuation for a very long time.
Yeah.
How sensitive is Nvidia's marks right now?
I mean, look, they just had a 40% round trip in the past 5 weeks. So the stock dropped 40%, it's recovered, and that's without earnings, just going into earnings. So clearly, you know, the investor base is quite sensitive, and I wouldn't say a very stable investor base that a $3 trillion market cap company has right now, but they are the darling stock when it comes to this Gen AI wave. We know this is a long-term trend, a super cycle. It's just a question of managing expectations, and so far they have shown that they can beat and raise that impresses investors. So I wouldn't be surprised if we see another positive reaction.
It's very interesting. Amy Wu Silverman over at RBC told us this morning that Nvidia's positioning has actually been bullish to the extreme, and the lack of extreme bullish positioning right now is fairly telling. Mandeep, thank you so very much. That is Mandeep Singh of Bloomberg Intelligence. Keep an eye out for his coverage. Of course, those earnings on Wednesday are going to be the moment of the week. Now we're going to next take a look at retail earnings out this week, because retail spending patterns could shed new light on the state of the U.S. economy, and of course a slew of companies this week as well. We're going to talk about that next. Stick with us. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Basak. It's time now for the stock of the hour. All eyes on consumer sentiment and margins this week, with many company retail earnings reporting this week. We're going to discuss it with Bloomberg's Emily Grafeo. And at the end of the day, when you take a look at the sector at large, it's doing pretty badly. And you have to wonder at what point it will get a bid. There's still so many worries about consumer spending weakening. How is the sector doing at large?
So if you look at the S&P 500 consumer discretionary sector, it is the worst performing S&P 500 sector year to date. It's still in positive territory, so it's up about 5%, but it is underperforming the broader market. There was a note this morning from Gina Martin-Adams at Bloomberg Intelligence, and she was pointing out that actually the EPS expectations, so basically the market's assumption of how much the earnings for these companies are going to grow, has been trending up since 2023, but the sector is still underperforming. She equates that to investors basically pricing in macro headwinds and concerns about rising unemployment, consumer sentiment kind of coming back a little bit, and they're kind of baking that into these stock prices and bidding them lower.
Well, when you talk to investors then, when they're looking at earnings this week, for example, when they're looking at the macro data, which one matters more? Because if you look at the names coming out, we've seen so much divergence. None of these names are going to behave the same. They all have different types of consumers. So which matters more at the end of the day?
I mean, that's a really good question, because like you said, it is really different when you look across the board. At least according to BI, she said that in the post-pandemic environment, the macro does matter more than it had in the past. Before the pandemic, the consumer discretionary sector, if you kind of map that out with consumer sentiment, they weren't always aligned, and now they've been trending together post-pandemic as consumers are more concerned about higher inflation, higher rates. We'll have to see if that changes now, if the Fed is really going to start cutting rates and whether the fundamentals are going to come back and focus more.
And even if the Fed starts cutting, maybe you get that 100 basis points the market is seeing, maybe very, very largely not. The market's been wrong all year. And there could be a weaker consumer going into next year. At the end of the day, we have a bunch of names reporting this week. What are we expecting to hear from, and how closely are investors not even just watching these numbers, but the guidance?
So we have Nordstrom, that'll be a big one. Also considering that we've already seen consumers getting more discerning in their purchases. Walmart, Target, they were better than, say, Macy's and Home Depot on the higher end consumer. So at least for Nordstrom, Citi had a note this morning saying they actually expect a little bit of a miss there. They're looking at early foot traffic data showing that the anniversary sale maybe wasn't as popular as before. So they're expecting a little bit of a miss there. We also have Five Below, which is majorly underperforming year to date, down about 60%. So that'll be another one that I'm watching, and also Gap and Best Buy.
Questions about Gap and Best Buy, but Five Below is a little bit curious here. What exactly has been going on there? Because as the name suggests, it should be targeted to people who are spending less.
Right. They've had a number of maybe not macro kind of related issues. They had their CEO stepped down several months ago. I'm not sure if I can speak to all of the details about exactly why we saw that, but that is true, that it is supposed to be geared towards the lower income consumer. And I think it speaks to that divergence that we're seeing, that some of these companies that you think would be doing well are actually still underperforming.
Emily, we thank you so much. That is Bloomberg's Emily Grafeo, of course, on a highly watched consumer sector. That is certainly one of the bigger stories of the week between consumer earnings and Nvidia. We are set to round out this earnings season with a bang. Now, coming up, we're going to talk to Ariel Investments. They're out with a study that shows boards are putting DEI efforts front and center. But boardrooms across a broader set of companies are actually less diverse. We're going to talk to Arielle Patrick up next. This is Bloomberg. This is Bloomberg Markets, and I'm Shonali Bassick. There's a new study showing that America's Fortune 500 companies continue to prioritize diversity, equity, and inclusion. However, that same study shows that the number of directors of color has declined across a broader set of companies. And here to share insights from the study is Arielle Patrick, Chief Communications Officer of Ariel Investments. And I want to talk about the numbers first, because it's interesting. The numbers across small and mid caps in particular were particularly concerning when you consider how many people across the country small businesses employ. So when you see the broader numbers, why are the broader numbers actually showing lack of progress?
So first of all, thank you so much for having me. I would say it's less about lack of progress and a slowing of progress. So it's fair to say that after the murder of George Floyd in 2020, there was an acceleration of efforts, particularly around the recruitment of diverse board directors. But since that huge jump took place, we're just seeing a little bit of a slump. And I think a big part of that is around the operational infrastructure that's behind DEI initiatives and who's accountable for moving them forward within these organizations, less so a focus on prioritizing it. So I think you're seeing a lot of headlines saying, you know, corporate America is walking away from DEI. We're actually finding that's not true. 98% of our respondents actually report that DEI not only remains a primary agenda item over the past several years, over half said that, but that the rest of that group said that it was added even in the past couple years. So the question is, how do you effectively take it forward? And we learned a lot in our research, which does look at Fortune 500 directors, right? So we're not really looking at small caps necessarily. Most of the directors that we are polling are at the nation's most influential companies.
Well, at the end of the day, too, very curious about your commentary here and what you're finding when you speak to these directors as well about the backlash against DEI policies that has been hitting corporate America in, let's say, more recent years. First, there was this big push after the murder of George Floyd to double down on DEI. And then in the past year, you have seen a lot of pushback for some of these policies. So how does corporate America navigate that?
So a few things. I think it's fair to say that, like any business imperative, if you are going to say that DEI is primary on your agenda, you have to back it up with measurement, accountability, tracking, reporting, incentives with leadership, education from the rank and file in the C-suite on why it's important. It's almost like saying that DEI is solely on the chief diversity officer in the way that, you know, financial goals for a company would only be on the CFO. That doesn't make sense. It's something that everyone across procurement, human capital, product, and philanthropy have to be accountable for. And so I think we're seeing a need for an up level in the conversation and a bit more sophistication in how that role is treated and how these executives are able to navigate these organizations and the expertise that they're expected to bring.
Where does this fall on the priority list? I think that this is a very important question that you were able to show in a data-driven way.
So what's fascinating is we not only polled Fortune 500 directors, but we also compared that to the average worker. If you ask each of those groups, they're saying different things. Board members believe 98% are saying it is a primary agenda item, and the reason that they are focused on it is improving the experience of diverse employees as well as their constituents with, that touch the organization that are diverse. Workers actually, fewer than half believe that their leadership believes that DEI is important. And when asked for the reasons why, the most popular responses were public relations and political concerns. So they're far more skeptical and think it's more of a short-lived effort as opposed to a genuine altruistic effort. And I think that shows that there's a vast misalignment and a need for education.
We have about 30 seconds left here, but I do want to get your opinion on another part of your life here. I know you've done some work recently with the Seneca Project, and also you've had recent polling numbers and data here around Kamala Harris's fundraising, a lot of it coming from women in particular. What are you hearing? Why are women being more galvanized, particularly to give to this campaign?
I'm very grateful to Crystal McCrary-McGuire, who asked me to just help host a Zoom providing education. But I will say that reproductive rights are top of the agenda for women right now, and that's the unifying factor no matter where you sit, which is why Seneca Project as a bipartisan organization is doing great work.
Arielle, we thank you so very much. That is Arielle Patrick from Ariel Investments, certainly talking about a very important study coming out from the firm, as well as a little bit about the Harris campaign. That does it for Bloomberg Markets today. I'm Sonali Basak. Keep an eye on markets through the close. This is Bloomberg.